Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for May 3rd, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined, as always, by Dean Croak, who's our Principal Industry Analyst, and Ned Damon, who is our Principal Data Scientist. Good morning, gentlemen.
Good morning.
Good morning.
It's May. Can you believe it?
Yep.
It's hard to believe.
I'm expecting just 1 to 2 more major snowstorms in Ohio before I can finally put the coats away and the snow shovel.
Yeah, I'm avoiding all those predictions. I jinxed everyone here in New England with the spring is over social media post back at the end of March. Dismally wrong.
So, hey, we got a lot to talk about today, and I'd really enjoy to get a great discussion going on in the chat and comment section below. I know everyone's ripe for discussion and argument and debate and all of that. So we want to be sure to make your voices heard here on the air. So if you can, get your comments, thoughts, questions in early. We've been pumping out a ton of content. The industry as a whole has been pumping out a ton of content. So if you have any thoughts or opinions on that, please don't hesitate to comment. Send us a message, and we'll be sure to cover those at the end. But I will get over to the key points because we have a packed show this morning. So, dry van and reefer spot rates continue to tip downward. I can't imagine that yesterday's EIA diesel update will have anything but a compounding effect on that. We're starting to see some plateauing in the contract rates, which is, again, what we would expect. Dean will get more into that a bit later. And then at the end of the show, we're going to really dive into some of those dynamics. Intermodal new rate differential up, just shy of 10%. It is Cinco de Mayo this Thursday, so grab some tacos, some margaritas, hopefully have some fun. Mother's Day on Sunday. It feels like a lot of this stuff is coming at us hot and heavy, so get those flower orders in, maybe some chocolates, something nice for mom. And then Road Check Week is 2 weeks away. And just because we love puns here on the show, it's time to pump the brakes. With that, I'll turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. This is the second year in a row that they've been talking about wheel ends and brakes and slack adjusters and brake linings and all sorts of things related to brakes. So it's a pretty serious subject. One of the questions we get asked the most is how should carriers prepare? And the answer is you shouldn't, because your brakes should always be in perfect working order. But anyway, nonetheless, you need to have a quick check around trucks and trailers more so, I think, around this Road Check Week. So let's start off the market update. Let's have a look at some of the dry van load board activity. End of month shipping volumes boosted spot market activity last week. Load post volumes were up 4%, not significant, but still down 17% year over year and 11% in the last month, closely tracking with 2018 levels, as you can see from the chart. Equipment posts were down last week, so as a result, the load-to-truck ratio moved up to 3.78, a 9% week-over-week increase. Similar in refrigerated, load post volumes were up 6% last week. Obviously, as Ken mentioned, Cinco de Mayo this week and Mother's Day are boosting some of the reefer volumes, particularly out of Florida, which we'll cover shortly. Equipment posts were down slightly. As a result, the load-to-truck ratio moved up from just under 6 to 6.55. Load post volumes are slightly above 2018 levels. Equipment posts, as the other component of the load to truck ratio, are about the same as 2018. Flatbed load to truck ratio volumes were up 5% last week, but still down 11% over the last month, down about 14% compared to this time last year. Carrier equipment posts dropped last week, so the load to truck ratio moved up to 70.02 from 64. Looking at both components of the load to truck ratio and flatbed, load post volumes are very close to 2018 levels from a demand perspective. Equipment posts from a supply perspective are very close to 2017 levels in flatbed. So having a look at our markets this week, when I looked at our top 100 lanes last week, loads moved as opposed to loads posted. Loads moved dropped on 78 of 100 lanes and increased on just 20. Spot rates down on 71 of 100 lanes. Across all markets, loads moved were down 7% last week, slightly unusual for end of month. In Los Angeles and Ontario markets, there was increased load board activity. Load post volumes increased 9% week over week. That's reasonably significant. It's a large freight market for long-haul carriers. Volumes have been flat for most of April in those two markets combined, but capacity continues to loosen. Spot rates in Los Angeles and Ontario dropped 6 cents a mile to an average of $2.25. Having a look at the East Coast, high demand in Miami for refrigerated trailers ahead of Mother's Day created a slight shortage of northbound dry van capacity. Rates are up just a penny a mile to $1.16. This wasn't the case on the busy Atlanta lane out of Miami. Rates dropped to just 73 cents a mile. That's 39 cents per mile lower than this time last year. On the long haul lane to Chicago, it's about 1,300 miles. Rates increased by 10 cents a mile to an average of $1.02. Still 10 cents a mile lower than this time last year. Capacity around Wilmington, North Carolina, still tight. Rates up 9 cents a mile to $2.33, excluding fuel. Capacity in Brooklyn still tight for the second week in a row. Load post volumes up 19%. Spot rates up 8 cents a mile to an average of $2.51. Brooklyn to Atlanta, rates increased 3 cents a mile last week to an average of $2.25. That's 23 cents a mile higher than this time last year. In the refrigerated market, in our top 70 reefer lanes, volume in terms of loads moved dropped on 50 of the 70, increased on only 17. Spot rates were down on 39 of 70 lanes and up on just 10. Florida, of course, is in the spotlight this week. Higher volumes ahead of Mother's Day is fairly standard last week and this week. Load post volumes out of Miami were up 15%. Average outbound reefer rates jumped 17 cents a mile to just under $2 a mile. On the 664-mile haul to Atlanta, spot rates increased to $2.48 this week. That's 58 cents a mile above the April average. Rates are around the same as the previous year on this lane, with more upward rate pressure expected this week. Last year, reefer spot rates between Miami and Atlanta jumped 30 cents a mile in this week in the lead up to Mother's Day last year. The same is occurring on longer haul lanes to Chicago. Rates are sitting at about $2.14 this week. That's 60 cents a mile above the average and about 4 cents per mile higher than the previous year. Similar effect to Boston. Miami to Boston currently averaging $2.65 or about 30 cents a mile higher than the April average. About 10 cents a mile lower than the previous year, though. But spot rates this time last year did surge to $3.24, excluding fuel, right before Mother's Day. Having a look at the market condition index for flatbed, we're having a look at the largest steel producing market this week in Gary, Indiana. Load post volumes increased 4%. That's after sliding for the last 4 weeks. Spot rates remain flat, though, at an average of $3.96, excluding fuel. Capacity was very tight on the haul west to Minneapolis. It's about 450 miles. Spot rates are up 5 cents a mile to an average of $4.38. Spot rates were the same, $4.38 on the run south to Columbus, Ohio, while they remain flat at $3.18 a mile on the loads west to Oklahoma City. In Houston, it's our largest flatbed market that we cover each week. Spot rates increased another 5 cents a mile in the average outbound rate category to all destinations, up to $3.08, excluding fuel. The number one lane out of Houston is Fort Worth. Loads moved dropped by 3% last week. Spot rates dropped by about 50 cents a mile below the April average to $3.28. Still up 50 cents a mile compared to this time last year. Capacity is tight on the West Coast, in Ontario in particular. Load posts were up 11% last week. Outbound spot rates jumped 17 cents a mile to an average of $2.90, excluding fuel. So wrapping up our weekly market update with a look at year-over-year spot rates. As you can see in dry van, there's still the downward movement in the red line there. Rates were down another 5 cents per mile last week to an average of $2.11, excluding fuel. Compared to this time last year, rates are about 7% or 17 cents a mile lower. They're down 67 cents a mile since the start of the year. Last week's national average is still 57 cents a mile higher than 2019 and 54 cents a mile higher than the average of pre-pandemic years going back to 2016. In the refrigerated category, similar story. Rates were down 4 cents a mile last week. That's the smallest weekly decrease in the previous 5 weeks, if there's any consolation in that. They ended the week at $2.39, excluding fuel. Now about 2 cents per mile lower than the Independence Day peak last year. They've dropped 23 cents a mile last month and 77 cents since the start of the year. Even though the previous week's average is now 23 cents a mile lower than this time last year, it's still 53 cents a mile higher than the same time in the previous 4 non-pandemic years. And wrapping up with flatbed, after getting close to the record high of $2.74 $1.5 per mile excluding fuel on July 4 last year. Flatbed rates retreated again last week, dropping 2 cents a mile. That makes it 3 weeks of successive declines, albeit fairly small decreases. The national average last week was $2.67 a mile. That is 6 cents per mile higher than the previous year and 33 cents a mile higher than the same week during the 2018 flatbed rate rally. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, it's over to Ned for the short-term forecast.
Hello, everybody. It's going to be another week of forecasts that maybe aren't the happiest, but let's jump right into it. We're going to begin with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our various forecast models. In green, the ratecast model is expecting that seasonality will be asserting itself and that we're going to be sort of pulling out of the fall, the free fall, as we head into the middle of May, with rates stabilizing at around 205 and then starting to head up as we move further into the spring. In contrast, the short-term model, which basically projects current trends forward and adds a little bit of extra sauce to it, is expecting that rates will continue to fall with the crossover point happening relative to the previous year back in in the middle part of May, with rates continuing to fall throughout the entire forecast period. In gold and silver, we have our two blended forecasts, which are mixtures of the two models in different amounts and in different ways. They're expecting the fall to continue, although they're leveling out at about $1.95 a mile in the middle part of May, hopefully sort of coming out of the free fall and into a more stable glide path forward. Moving on to reefer. Once again, in blue, you can see the market rates observed by DAT. And then off to the right, you can see our model suite. Ratecast is, I think, being way too optimistic. It's given the way that produce season has been behaving, expecting that there will be strong, normal produce going forward, and rates will rise over the next period by about 15 cents. In contrast, the short-term model, which expects that current trends will keep on trending, is dropping pretty aggressively, ending at about $2 a mile by the end of the forecast period. And that short-term forecast is in red. Our blended forecast, which are mixtures of these two models in different amounts and in different ways, are expecting, again, things to continue to drop, although there's a little bit of stabilization happening as we move into the middle part of May, with rates coming to some kind of a stable plateau at around $2.25, $2.20 a mile. Finally, moving on to flatbed. In blue, once more, we can see the market rates observed by DAT. And then off to the right, we can see our various forecasts. Excuse me, I've got quite a bumpy throat. In red, our short-term model is expecting that the recent drops will present themselves as a sustained trend, with rates dropping by about 5 cents over the next month. In contrast, in green, our ratecast model is expecting rates to stabilize at about current levels and then a little bit of a rally, rising by about 3 or 4 cents as we move into that same period, as we move into the more of the summer. And then our blended forecasts in gold and silver, which are mixtures of these two models in different amounts and in different ways, are expecting that the drop basically to continue as per the short-term model, although stabilizing as we move into the middle part of May. And with that, that moves us on to our IQ question of the week, which is, what is a freight recession?
And are we in one right now?
And are we in one right now? Yes, that second part.
So let's tackle maybe the first one, because this is like the hot topic, right? This is the, well, before I think the EIA's fuel post last night, this was the raging debate happening out there. And it seems like people are trying to draw battle lines. And I really don't think that should be the case, because I don't know that there's a good definition. It's why we chose this as our question this week is, what is a freight recession? So let's just talk about what a macroeconomic recession is. And again, having just wrapped up with an A, I might add, my graduate level economics class, I'm an expert. As a typical American, I feel like I'm totally able to opine on this, and I'm way more qualified than Jerome Powell. But anyway, it used to be when I was a kid, 2 consecutive quarters of declining GDP meant you were in a recession. And apparently that's not the case anymore. It's when the governing board on recessions determines we're in a recession. So it's more of a state of mind. So the most recent recession, right, would have been the post-COVID couple quarters, right? If I have that right, so like Q2, 3, 4 of last year, or 2 years ago. Does that feel right?
Yeah,
But
I think.
Okay, yeah. So I struggle with the applicability of that to a market so cyclical, right? So GDP has a pretty much, at least in the developed world, up and to the right, right? The slope of that line might change, but it's a pretty upward linear growth rate is what's expected. So anytime you deviate from that for a short period of time, we're in a recession. Is that kind of how you both understand things to work?
Mm-hmm.
Yes.
So it's really hard in a cyclical market to determine like any downturn to be a recession. I mean, by the definition of the vocabulary word, I guess it technically is. Freight rates are receding. Freight volumes potentially could be receding. We're not seeing that yet, but it's like declaring a recession on Halloween costumes on November 1st of every year is the best way I can really describe it, right? So how would we think about whether freight's in a recession or not?
I mean, I think if we're moving away from the dictionary definition and we're kind of looking at things that people have previously called freight recessions, in my memory, there have been 2 things that people have labeled freight recessions. And those 2 things are 2015, there was a claim of a freight recession. I remember talking to Mark Montague back in the day, long, boring story alert. And then in the fall off of 2018, as we moved into 2019, if my memory serves, people were talking about there being a freight recession. So, what do those 2 periods have in common? I mean, it's essentially spot rates falling.
Well, I mean, the definition I've been toying with, because I gave a pretty bad answer by my own admission. We were talking with, I think it was Jeff Berman, Kaplis and I were talking, and it's like maybe a shorter time period of declination. Maybe it's like 6, 8, 10, 12, 14 weeks in the freight market. But really, then I pivoted to, is it a sustained period where current for-hire trucking dips below operating cost, all-in operating cost for a carrier? But that's not really the case either, right? Because that almost always happens in the downswing of the market, right, Dean?
Yeah, correct. And only for a certain sector of the market, right?
Right. It was essentially like small carriers exposed heavily to the spot market.
Correct.
Mm-hmm.
Or carriers that have a pretty nice head haul back haul arrangement and they lose the head haul portion of that, right?
Right.
Yeah. So I guess I don't have a great definition. So all of this arguing on whether or not we're in a freight recession, and I haven't really seen a good. It's certainly not tied to GDP. So I think. I think Dunning and Kruger were quick to claim victory whenever we saw the surprise GDP dip, right? We saw GDP, surprisingly, the preliminary numbers go negative for Q1 of this year, driven by a whole bunch of reasons. I think there's a whole litany of things to unpack there that I'm not qualified in the slightest to do. But I don't know that negative GDP signals a freight recession. Would anyone go on a limb and say that it does?
No. You know, Ken, the thing that struck me is that Ned was talking about the last 2 freight recessions. I was very interested in some of the analysis Jason Miller pushed out last week, talking about how industrial production numbers are very different this time around. In fact, he used the word trajectory, which I thought was a good way to describe it, because it's all up. Industrial production, durable goods industrial production is up 6% year over year. When you look at 2015/16 and then 19, they were clearly both heading downwards during those freight recessions. Chemical carloads are up 8% this year. Machinery is hitting very high numbers, so are appliances. There's a lot of flatbed and dry van demand out there right now. So it's not a demand-driven recession as far as I can see, certainly for the time being, noting that inflation is probably going to have some sort of an impact on future demand. Right now, those demand signals look very strong for truckload carriers.
We saw over a million dry van load posts on our board in the last 2 weeks, each of the last 2 weeks, right? And in 2019, we saw roughly 500,000 each week, give or take.
Yeah.
So I agree. that we're not. So can we all agree at least that we're not, regardless of your definition? I'll go out and again, I'm going to get like a shirt that's just called like lukewarm takes, because I'm not in the hot take business. Other than thinking Ohio State's going to win the national title this year in football, but other than that, my lukewarm take is, regardless of how you define it, today, May 3rd, 2022, although Michigan may still suck, we are not in a freight recession. Would anyone take umbrage with that? Today, as it stands today, we are not in a freight recession.
I'm with you.
I'm with you, but I don't think that that's a lot of comfort for folks, right? Like
correct.
To go back to the vibes-based definition. Yeah.
Let's put a pin in that. So, as we stand today, and it's important to note that in any macroeconomic analysis, recessions are largely studied after the fact, posthumously, right? We go back and we study big recessions. Very rarely, when you're in it, especially in the beginning, do you know that you're in it. So I understand there's a little bit of take what we're saying with a little bit of a grain of salt, right? We understand that everything that's happening right now may not be known, but from all of the indicators we can see, we might not have the highest frequency data. Again, that's another T-shirt I want to get made. May not have the highest frequency data, whatever that is, but we get roughly $500 million worth of actual paid freight bills delivered to us every single day for that previous day's pickups, and we're not seeing today recession. What are we seeing then? So let's just kind of pivot the conversation into what are we seeing. I think Dean covered most of it, and I want to address your point, Ned. Spot rates have come down considerably, right? Yes. So if you're a carrier, let's just talk about health of the carrier for a minute. You've seen revenue come down considerably from where it was at the end of last year. How much, Dean? What are we talking about cents-wise, percentage-wise?
Profitability's dropped in the last year, 172% for the small carrier, totally exposed in the spot market. So gross profit's down 69 cents per mile. So this time a year ago, if I was a small operator in the spot market running 110,000 miles a year, fully financed truck, I was making 52 cents a mile. Today I'm losing 17. So it's a swing of 69 cents per mile. Yep.
Wow.
So
that's assuming I'm not
down.
getting any. Yeah, exactly.
Yeah, revenue's down.
Yep.
Operating costs are up.
Yep.
Now, here's where it gets kind of different, right? If you're in some kind of fuel recapture program, whether that be running for large or medium-sized shippers that have a fuel surcharge, some of that is offset. Like let's just kind of go to the worst case scenario. Exactly. You are a small carrier operating 100% on the spot market, and you get 100% of your freight from brokers.
Yep.
So your revenue is down considerably from the start of the year. It's still considerably above where it was in 2018 or even 2020 at this time, right? We're talking, and certainly well above where it was in 19. So revenue down, but still higher than average, like a 5-year, 7-year national average. But your costs are way up. And that's really like the money. That's really where you're feeling it the most, right? Yeah. If you don't have a fuel recapture program, diesel's up $2 a gallon year over year, roughly?
$2.29, exactly.
So it's 6.5 cents a mile. That's what per mile? What is that? 220.
85.
34 cents a mile. You're making less. You're putting right into the, and then that's on loaded miles, right? You're putting right into the diesel tank. So revenue down, costs up, something to be extremely mindful of. So I do agree, and would anyone disagree with the fact that this will probably disproportionately impact smaller carriers, large carriers, the Schneiders, Hunts, Swifts, Heartlands, U.S. Expresses of the world. By and large, they're hedging their fuel, or they're on a fuel recapture program. They have substantial discounts with a lot of the big fuel providers.
Right.
They should be able to weather this a little bit better.
Yeah.
Is that fair?
Yeah, very fair. And I think the impact is going to be on a lot of those new entrants that have joined the industry in the last 18 months because of record high spot rates. So I think that's where the real exposure is. And my numbers are sort of the worst case scenario, as Ken mentioned. Top line revenue is down $17,000 a year in the last 12 months, but diesel's up $38,000 a year on just running one truck. So it's a massive swing in profitability that even after a year of incredible profit margins, it's going to take, this will be a real test as to how long carriers can weather this storm. Some of the anecdotes you see on social media are, we'll ride it out, we'll park our trucks. So you won't necessarily see exits out of the industry, I think, this year. I think carriers will do a few things, right? So they'll go and drive for someone else. They might not necessarily sell their equipment. They may be power only. They may park their entire combination and, work in the grain harvesting season. There's a lot of things carriers do when times get tough like this. They don't all go out of the industry. That's the important point, especially after a good year.
So let's recap this. So really hard to define whether or not we're in a recession or not. So it seems that seems to be highly subjective. And we can all pretty much agree that a recession being a down cycle that's worse than typical, right? So if spot rates normally come down 20%, or if a recession may be a period where they're down 30, 40% for a prolonged period of time, and that inflicts economic distress on the carriers.
Yeah.
Right. Kind of the inverse economic stress that is applied to shippers when the market's up, right? What you're really doing is shifting that stress. And unfortunately, the sad fact of it is the large and medium-sized shippers are much more well-funded. They have a lot more reserves than small carriers. So when the pendulum swings, the felt impact by those small businesses is largely disproportionate to the pain shippers feel when rates are up. That's point one. Point two, we're probably only a month or two into this down cycle. Down cycles typically last basically half of the entire market cycle. So we could be in for another 6 to 8 months of soft spot market rates. Spot leads contracts, so I would expect as contracts are rebid, we did see a ton of shippers put in shorter length contracts. We could very likely see contract rates tip down. They won't go down as far as spot rates do. It just doesn't work that way. So what we expected to happen after the 4th of July when we had our end of year show is probably happening now. We'll probably continue through the summer and really looking to the retail peak this fall to see if that stems the downslide. Is that anything overly controversial, do you guys think?
I mean, I'd say the only thing that could halt this is if carrier profitability continues to go down, you could see a lot of exits from the market, and that might cause some buoying of rates just from supply and demand. But that would have to be really...
Counterpoint. Yes. And 2018, anyone could... I'm sure someone will find an article or something will post they couldn't buy a truck in 2018. They didn't have some, but you could by and large go to a dealer and buy a truck and have it go drive it.
Yeah.
The market in a kind of a convoluted way may have saved a lot of the capacity pool from itself in that those units weren't delivered. We absolutely saw more capacity added, but had inventory been totally fluid, I think we would have saw way more capacity added and probably put
100%
put the hurt in. Yeah. So there's a lot at play here. I think the point is there's still a lot to be determined, and looking to, grasping at macroeconomic straws to prove a point is not perhaps the best approach. Speaking of not the best approach, I want to codify, like, our position on this is, we're tracking it, we're responding in real time to what's happening, but what we take umbrage with the most is this sense of dancing on the presumptive graves of all of these small carriers, right? Small business is the backbone. I saw the Freight Coach was in our comments section today. I had a great conversation with him earlier this week, and it really put into perspective, small businesses, these carriers are small businesses. There's a lot of small brokerage businesses, whether they're agencies or not. And they will be very exposed to this, as we've just laid out. And a lot of this language is inflammatory. It's detrimental to what they're trying to do, how they're trying to navigate this. So I think as an industry, as a kind of expanded industry around those firms, I think it's in our best interest. It's definitely in their best interest for us to, I'm not suggesting we stay positive in the light of objectively negative news. I'm just suggesting that perhaps it's better to be helpful than sensational, that perhaps sometimes the risk of getting the scoop needs to be weighed against the potential risk of being wrong and how that would impact your constituency. But it's just something to think about, right? As we operate here.
Yeah,
probably should keep the personal attacks on social media, like happened to me last week, to a minimum. Also,
yeah, that would be something to keep in mind.
Yeah, dare I disagree with them?
So I think too, it's just how do we be helpful? There's so much information, there's so much talent, right? That's what I think of. If during COVID, it's brought all of this talent into new ways to interact with people in freight, and people that would have never thought to have use their LinkedIn account or their YouTube account to create content. And so much of it is good. So much of it is good and helpful in ways that, because I do believe you can be successful in up, down, and flat markets, right? Even in 19, it's not like 80% of small carriers went out of business. We're talking about the margins. And frankly, sure, the market was to play there, but I can't say that taking out a truck payment with bad credit and no business plan and poor insurability had nothing to do with it either, right? So again, I think there's ways to be successful. I think helping all of us do better when shippers, carriers, and brokers are doing well. So that might be something to keep in mind. Certainly at DAT, we are successful when our carriers are successful. We are successful when brokers are successful, and we're certainly, our success is predicated on shippers, carriers, and brokers all having success. And we believe that's possible whether the spot market's going up or down.
Do we have time for a listener question?
We have time for a couple. Let's let her rip.
Julian Bristol asked, what's the reason for rates per mile dropping the way they did? I haven't seen at least $3 per mile since late March.
Yeah, I wouldn't expect to see $3 a mile for a long time either.
Yeah.
I mean, rates are dropping for a lot of reasons. We can't cover a ton of them. Maybe that's our Ask IQ question next week. It's not all. So fuel, right? Fuel has, if you're a carrier that's lucky enough to have some fungibility between the spot and contract market, and you're not getting full fuel recapture on the spot market, but you are on the contract market, it's going to make it much more advantageous to go over there. Carriers are becoming more sophisticated in that, especially non-asset or blended asset-based carriers. They might want to nudge themselves over to contract when they sense the spot market coming down. So there's absolutely more volume moving via contract. Routing guides are holding up. When you hear that term, that just means less freight is spilling off the routing guide or being rejected by the core carriers. It's still not at pre-COVID levels, right? But it's just better than it was. Another reason rates are dropping is, as that freight moves over, you see demand come down, but then the capacity pool largely remains the same. And there's been capacity attracted to the spot market, and that has momentum that comes with it, right? So you have more marginal capacity, less marginal demand in the spot market. Even though it's still a robust amount of demand, it's less than it was. So the supply and demand, where they meet, that would dictate that rates come down. And I'm kind of talking with my hands on the table here, but that's largely what we're seeing.
And just
another
general
seasonality.
Ahead, general seasonality as demand cools off in Q1. Is another factor.
Yeah, one other thing that I wanted to talk about when you're talking about like the supply side of the supply and demand has been relatively constant and maybe a little bit down, but the supply, not only do you have the growth of carriers who are moving into the spot market, but also something that we've maintained for a while is that the capacity that was in the market over the last year has been sufficient. It was just poorly distributed. And as these kinds of bottlenecks and hinky business get sorted out and you get better throughput, effectively you have more supply of carriers, you have more supply
capacity.
More available capacity than was available before without any like fundamental changes in the number and the constitution of the firms that are in the sector. Yeah.
Good point.
Yeah. And again, we expect this to continue at least in, we're going to see a seasonal pressure upward on rates. I don't know if that'll be enough to outweigh some of the other fundamentals that are pushing rates down, especially not with fuel coming up. A couple other quick questions. I saw there were some. I don't know if they made them over. But,
I don't see any in the.
I've been lurking in the LinkedIn this morning.
Okay. All right.
Steve asked about spot rates seem high, but the rates are going down. I asked a follow-up about whether that was a lane-specific rate or a national rate. No response. Maybe that's something, Steve, if you want to shoot us an email or shoot a question to me directly on LinkedIn, we can answer.
AskIQ at DAT.com for all your questions.
Yeah, that's another one. Closely monitored inbox.
Yep.
But yeah, we're going to keep watching it. We'll keep reporting the news as it comes to us. Anything else I'm missing that we haven't covered? We all need to get along.
Yeah.
Be friends. Yep.
All right. This was our 100th show, by the way. Did you guys know that?
No.
No.
Wow, awesome.
They haven't
Yeah.
canceled us yet, which is remarkable.
Right.
But
Shout outs.
I should let's do our shout outs. I should probably take some of my
Yes.
own advice too with some of the being friends. Maybe that's my personal development. Replaying the Dunning-Kruger remark earlier in the show probably was in poor taste, but
So this week,
shout outs, Steve.
this week we're on Landline now at 7 p.m. Eastern tomorrow evening. That's Wednesday evening on Road Dog 146 on Sirius XM. And of course, we're live tomorrow morning. It's Data Wednesday on Sales Chatter with DJ Flores and Dan Deegan. You can follow both of them on LinkedIn and get the link to the show there at 9 a.m. Eastern.
Yeah, great show. I really enjoy listening to that, especially on Wednesdays. I wonder why. That one piques my interest, especially.
Right.
I will most likely be out next week traveling, maybe the next couple weeks, but I trust that we have a bench. That'll probably be an improvement over me babbling here. But with that, we are running long. Any spillover comments, thoughts, debates? Where did we get it right? Where did we get it wrong? What aren't we seeing? We are totally open. We don't pretend to know everything or see everything. So, drop us a line, start a conversation. I think that would be great. As long as it's not about Michigan football. That's pretty much the only thing I'm not really interested in talking about. But other than that, I hope everyone has a great rest of your week. Buy your mother some flowers, have some margaritas. We'll see you next week. Bye, everyone.
Okay. Bye.
Adios.